Depending on your overall portfolio allocation, your performance could range from very strong double-digit growth year to date to in fact being absolutely obliterated. For example, those that hold heavy positions in the semiconductor space, we're seeing nearly every company in this area up double-digit. But the complete opposite, for example, those that were positioned in healthcare at the beginning of the year, we're talking some have had their market cap wiped out by around a half. We're also noticing a pullback from extreme greed a few months ago to today, now seeing investor sentiment sitting in neutral, and you could argue we're seeing a lot of negative posts being pushed by the media. We have the New York Times coming out to say the stock market is getting a little bit scary. What should investors do? We have one of the most bullish analysts on Wall Street, Tom Lee, expecting a correction anytime soon. Although long term, he is still bullish, seeing the S&P climb up to 7,000 points. And this is something that's also shared by Morgan Stanley. A pullback in their view is coming very soon. Having said that, both of them still very bullish, and Morgan Stanley in particular believing that artificial intelligence as a whole will add a lot of growth to the S&P, hence why they see the momentum only continuing to climb. But we should also factor in seasonality. For those investors that like to look at history, September is typically the worst performing month going back to 1928, and by quite some distance. In fact, as we're coming towards the end of August, just yesterday we've seen a fairly red performance. In fact, if we zoom out to the last week, we can see many industries are getting hit, although you could probably gather from this a little bit of rotation. Those companies that we highlighted at the beginning that were very strong, for example the semiconductors, most of them are down, whereas the healthcare sector, which was neglected, is starting to pick back up. And we also have some macro news where the Fed Chair Jerome Powell is expected to speak today, where investors are expecting this to have a fairly significant effect on the market, as we will understand whether or not rate cuts are coming and anytime soon. And in the episode today, we want to look at undervalued stocks, those that are trading near their 52-week lows, because ultimately across the market, no matter what valuation metric you look at, this covers price to sales, price to book. We're talking EV to EBITDA as well as EV to sales. The majority of the market isn't giving too many opportunities, and that is what we want to dive in today. And before we jump in, we just want to flag that we do release a free weekly article to your inbox every single Monday morning, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So if you click below, you can sign up and read these straight away, where you'll also be able to gain access to severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released spreadsheet of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Jumping into stock number one, we have Bristol Myers Squibb, pretty much flat over the last year. Year to date though, it is down 14%, and if we look, it isn't trading too far off the 52-week low. Now we only have one buy rating, which is from Seeking Alpha, and whilst we won't do a deeper dive into the gradings, we can see looking respectable, B+ on valuation, A+ on growth, and an A+ on profitability. And when we look at the forward valuation of 7.7, it does come below their 5-year average, although fairly marginal. One thing that looks good though is a very attractive starting yield, 5.1%, which is well above the historical 3.4. So actually on both occasions combined, we do see potential undervaluation. And we want to flag that with the high yield above 5%, dividend safety score of 70 does look good, as we can see here. And the blue tunnel also confirms the potential undervaluation. Now remember, the parameters here highlight the intrinsic price. It is sitting right towards the bottom end, so we may see it slip slightly out, which will confirm the severe undervaluation. but also we have to make you aware the blue tunnel has been decreasing over the last 12 months. And with each of these stocks, we'll highlight what the institutions have been doing. Now, BMY, they hold 76% ownership. They sold just under 10 billion in the last year. Same time frame, they actually bought twice as much. And not only have they been net buyers in the last year, but in the most recent quarter, they bought nearly twice as much as they did in fact sell. So bullish indication. And if we want to keep going to find the reversal of the trend, you would have to go to Q3 2023. Now, each one of these we will just run through at a very high level our intrinsic price, which for BMY comes to $62 a day, the average of the three. And as always, when we do our deeper dives, we do run through every single model. What we'll flag though is the DCF in particular, which actually comes to there or thereabouts in terms of the average. We want to just flag on a reverse DCF approach that baked into the numbers is a decrease to their future free cash flows of negative 6.6% year on year. And actually, to arrive at our figure, we've used a fairly conservative negative 4%. And based on that, it gives rise to a 23% margin of safety. Now, if you're someone that actually wanted a larger one, well, at 30%, a buy at around $43.62. But as of today, 23% margin of safety, a yield above 5%. And Wall Street, whilst they haven't got a buy rating, they still see upside $55 into next year, translating to 15%. Let us know your thoughts. As always, you can grab a copy of this model as well by clicking on the pinned comment below, running through your own numbers, whether it's for BMY or any others. And we then move into the oil industry with ExxonMobil down 4% in the last year. Year to date, they're up, although marginally, and over the last 10, this one again, whilst it is up only 46%, you would have underperformed the S&P. It's really if you'd bought 10 years ago today. For example, those that took advantage of the COVID dip where it was trading around the $32 mark, well, you would be up right now and very significantly. It's trading towards the lower end of the 52-week range, a strong buy from Quant and a double buy from Seeking Alpha and Wall Street. However, we do notice the forward PE of 15 does sit above the 5-year of 12. Now, this in isolation would highlight potential overvaluation, but actually the yield you're getting today isn't too dissimilar to the historical average. And again, good to see the safety score sitting there at 80, and their most recent increase was November last year around the inflationary rate. Now, as we mentioned earlier, their PE does sit above their historical, which is why we get confirmation again here of a potential overvaluation signal. And institutions, whilst they don't hold a lot in comparison to other stocks that we will come on to, 62%, they've sold 18.4 billion. They've bought more than twice as much in the last year, but actually they've bought around 3 times as much in the most recent quarter. They are net buyers, they are very bullish, and again, reverse of the trend, you'd have to go to Q1 2024. Now, our intrinsic price, $126, and as we can flag the DCF, not too much disparity actually between the two overall, is baked in today a negative 2% decrease to the future free cash flow. Now, we've gone for 0%, which we do believe, in all honesty, is a little bit on the more conservative side, and this gives rise to a 14% MOS. If you wanted 20%, well, a buy around the $100 mark, and at 25 around $95. Wall Street themselves see this at 130 into 2026, 19% upside, a yield around the 3.5% mark, maybe one not just for the gain, but also a nice attractive long-term yield, very similar to BMY. We then move on to CMG Chipotle Mexican Grill, hammered 20% in the last year. Year to date, nearly 30%, and over the last 10 years, they've still managed to marginally outperform the S&P, up around the 200% mark, trading very close to 52-week lows. Now, whilst we only get one buy rating from Wall Street, bear in mind 4.41, very close to 4.5 to flip this into a strong buy, and the valuation does sit on a forward P around the 35 level. But we should make you aware one of the reasons why the share price did decrease in the not so distant past was because their comparable store sales growth is on a bit of a decline. We can see it peaked in June 24 at 11%, and as of the most recent quarter is down around 4, so you need to have a long-term bullish outlook to really consider CMG. And we'll also flag, as we have discussed this a lot in the last few days, that on a price to earnings growth basis moving forwards, they sit around the 2.1. Now that is above the sector at 1.8, so you're paying a 19% premium, but we can see actually a discount if you're looking at CMG's own 5-year average. And we can flag it does deserve a premium to the market because their revenue figures are significantly above where the sector in comparison sits in the low single digit. EPS also looking very strong at 17% when the sector comparative sits at 10.6. Now institutions hold 91% ownership, selling 7.5 billion. They've bought nearly twice as much again at 14 billion. They bought around 50% more in the most recent quarter, and actually over the last few quarters they've been incredibly bullish, continuing to add. Now our intrinsic value at $70, which is solely derived from the DCF, is actually using the middle rate today of 20%. As always, these numbers here are subjective, 15, 20, 25. If you believe though 15% to be more appropriate, well, it comes to $49, 14% upside. If you believe actually the upper end 25%, then $99, more than a double at $130. Now baked into the growth today is 13.2%. If already you think that is too high, then this may be an overvalued case in your opinion, and vice versa. We will just flag over the last 2 years it has grown fairly strongly, so if you do want to use the middle rate at 20%, then you are getting a very hefty margin of safety at 39%, where Wall Street see this at $60 into next year, 40% upside. We'll also flag the margin of safety that is available on the lower end of 15% today. It does sit around 12%. If you believe that is the case and want it on the watch list, well, at 20%, a buy perhaps around $40, and at 25%, we're talking 37%. Wall Street nonetheless very bullish, 40% upside. Give us your thoughts on CMG, whether you see it as a buy, hold or avoid. We then move on to United Parcel Service, battered 33% in the last year, year to date down 32%, and over the last 10, this one actually now has given a negative return. Not great if you're an investor. Over the last 10 years, you'd have less capital now than what you initially invested in, and it's trading pretty much at 52-week lows. Now we do get a double buy from Seeking Alpha as well as Wall Street, and a forward P below 13 is significantly lower than their average of 16.3, yield well above 7.61 when historically this is sat at 3.5, but we do need to make you aware that given the high yield, the dividend safety is sitting borderline safe at a level of 50, and that most recently, given the performance of this company, the dividend increases haven't been anything strong. We're talking most recent one this year at 0.6%, and the main culprit for this borderline safe dividend score is that when we look at the free cash flow payout, which as always we draw your attention to over earnings, as this data is susceptible to manipulation by management to accounting, we want below 60%, ideally to give us faith management can offer nice increases, not something we've seen from UPS. Well, look, on a trailing 12-month basis at 157%, this indicates management are paying out more in dividends than they're generating in free cash flow. Does it mean a dividend cut is on the way? Maybe, maybe not, but definitely something we would say for consideration whenever analysing UPS. And like on a forward PE, when we look at the blue tunnel, it is decreasing, so worth flagging, but we notice disparity at the bottom end, an undervaluation point. And actually, over the last 5 years, 2 things to note. Firstly, this one has peaked pretty much in 2022, since then on a downward trend, but also very rarely does show itself in a severely undervalued level. Lots of things we would say worth considering, and institutions with their 60% ownership selling 9 billion have bought more in the last year at 14. They've also bought twice as much more in the most recent quarter, although you have to go to Q2 2024 where we saw the reversal, and that was also the case in Q1. Now our intrinsic value, $108, the average of the 4, actually flags that the DCF model puts it higher at 122, where baked in is a decrease to the future free cash flows of 3% year on year. We've used 1%, which again you could argue is very conservative, but overall on average we are seeing a 20% MOS. If you wanted 25, a buy around $81. Wall Street themselves see this at 108 into next year. That is upside of 26%, whilst also getting yield above 7%. maybe one for serious consideration, or maybe one to completely avoid? Let us know your views. We then move on to Energy Transfer, which is up 9% in the last year. Year to date, down double digit. Over the last 5 years, one that has outperformed quite significantly the S&P, trading in the mid to lower end of the 52-week range. A buy from Seeking Alpha in quant with a strong buy from Wall Street. And honestly, we wanted to incorporate this in the episode today because there has been a very significant large insider buy from a director, we're talking days ago, where they added 2 million shares, costing them $35 million. Now, on a forward P to DCF ratio, we can see it is actually above the 5-year and the yield is below. Now, both signals, purely in isolation, would give rise to a potential overvaluation signal, and the dividend safety, while sitting at 50 borderline safe, doesn't have any red flag indicators, something we did note in fact from UPS, because when we look at the payout ratio, something specific for MLPs, we use the DCF as opposed to the free cash flow, we can see it is well below 90% since 2018 and expected to be around the mid 50s, low 50s over the next year, and the net debt to EBITDA is fairly consistently below the maximum 4.5 that we want to see, but again we are noticing potential overvaluation. That is why we always say we never look at this in pure isolation, but is something as part of the wider analysis. In institutions with their 38% ownership actually sold a little bit more in the last year, 3.4 billion versus 2.9, and in the most recent quarter, in fact the last 2 quarters, they've been fairly indifferent in terms of both buys and sells, yet our intrinsic value at $24 is pretty much in line with where Wall Street see this into 2026. That is very high upside of 37%, a very attractive starting yield, and we're also seeing around a 28% margin of safety. If you wanted 30, sitting around the $17 mark, and if you wanted around 40%, sitting at just under 15. Energy Transfer, large insider buy, which is one of the reasons we wanted to highlight this again in the episode. Let us know whether you see this as a strong buy, hold, or sell. We then move on to PayPal, one we haven't covered in quite some time, down 5.5% in the last year. Year to date, down 21%. Over the last 10 years, not the greatest at 93, where we can see it peaking summer 2021 above the $300 mark, trading towards the lower end of the 52-week range, a double buy from Seeking Alpha and Wall Street, and a forward valuation just below 13. Now, this is one where management and for quite some time are continuing to do a massive amount of share buybacks. In fact, they're using more than all of their free cash flows to continue buying back shares. And on a valuation perspective, they do get a D. Now look, on a forward PE and on a historical trailing 12-month basis, it is sitting slightly above the sector, so you are paying around a 12 to 17% premium, but actually against their own 5-year average, they are trading at around a 50% discount. And when we do look at it on a price to earnings growth, we can see at 1.3, pretty much in line with the sector, but at a little bit of a discount, around 22% to their own historical. And institutions with their 68% ownership, selling 6.3 billion, have bought twice as much in the last year. They've also bought a lot more in Q2, and if you want to see the reverse of the trend, well, Q1 2024, and that is something, as we can see, is a little bit less often than in fact the buying. Now, our intrinsic price at $125 is really derived using the lower growth rate at 2%. In fact, baked in today is a decrease of around 7% to their free cash flow year on year. Whether you use 2, 4, or 6, we are talking about a massive amount of upside. Now, if you do agree, you are sitting around a 47% margin of safety. Wall Street themselves see this at 86 into next year. We're talking 28% upside. But for those that want to be even more conservative, if we use a 0% growth rate, so absolutely no change to the movement over the longer term, you're still getting a 38% MOS. If we go one step further and say negative 2%, then in fact you're still getting a margin of safety around 28%. So it could be a value play, or perhaps if you disagree and see it as a value trap, do let us know. We then move into the healthcare sector. Now, we do typically talk about UNH, so we want to bring another one into the mix, ELV. down 43% over the last year, down 16 year to date. Over the last 10, slight underperformance of the S&P, up 120%, trading near 52-week lows with a double buy not only from Seeking Alpha and Wall Street, but fairly near the 4.5 to flip them into the strong buy. And the forward P below 10, we can see historically much higher at 14, yield 2.2, again above the 5-year, with an incredibly strong 99 very safe dividend score, which is in fact the highest one obtainable, and is slightly above inflationary increase to the dividend this January, and no surprises to see that disparity between the 2 points after what we've just discussed, so another severe undervaluation signal, which actually when we zoom out to the last 5 years, we can note more often than not this is trading in a reasonable level. Very rare to see it like in 2025 in that severely undervalued space, where institutions with their 90% ownership selling 11 billion have bought nearly twice as much, and actually they've bought twice as much in the most recent quarter, 4.5 billion buys versus 2 billion selling, and the reverse of the trend, well, you'd have to go to Q1 2023, so clear and obvious to see this is an institutional favourite. Now intrinsically, $417, again the average of the 4, which as always, you can grab a copy by clicking on the pinned comment below, is giving rise to an estimated 4% future free cash flow growth at the current trading price. We've gone 6%, which does lead to 374, but on average, intrinsically incorporating the other models, we get slightly higher, which gives rise to a 26% MOS. If you want 30, then a buy around 292, which we did see not that long ago. In terms of Wall Street, $370 into next year, 20% upside. Is this one to consider? Maybe you prefer UNH, or maybe this industry just isn't one for you at all. We then move into China with JD.com up 15% in the last year. Year to date, down around 10%. Over the last 5 years, this one is also down, not looking too good, but trading towards the lower end of the 52-week range. Strong buy from Wall Street and a buy from Seeking Alpha with a forward valuation around the 12 mark, and it also pays a yield on a trailing 12 month at 3.2%. And great to see an A on the valuation grading. When we look at a forward P of 12, it is not only below the sector, so a 31% discount, but you're also getting a hefty 53% discount to their 5-year average. Only thing we would say, as we do like to incorporate this on a price to earnings growth, it does sit on the higher end at 2.6, which is actually a premium to both sector and their own 5-year. And institutions with their 16% ownership sold 2.5 billion. They've bought nearly twice as much, but actually the first one we've spotted today, where in the most recent quarter we get the opposite trend. They were selling more than they were in fact buying. And our intrinsic value gets to $41, where in fact if you want to use a DCF model, we've used 0%. Again, you could say that's very conservative. Baked in is 14% decrease year on year, so you can see massive misprice between the current value and to the growth baked in. Now 25% MOS, some investors may like that or may want more for companies like JD. 30% MOS, a buy at 29, at 40 around 25, and at 50 for those that want to note around the $21 mark. Wall Street have been very bullish on this for quite some time, $43 into next year. 39% upside. Maybe you like this one, maybe for others in a similar boat. Let us know your views. We then move into the REIT industry with Alexandria Real Estate down 33% in the last year. Year to date down 21%, not looking good. Over the last 10 years, this one actually in a bit of a decline as noted from the back end of 2021. Trading towards the lower end of the 52-week range. Strong buy from Seeking Alpha and a buy from Wall Street, where we see massive disparity from the forward P to adjusted funds from operation, 11 versus 19. Yield pretty strong. We've seen some good ones today, near 7%, historically 3.5%, and good to see 76 on the dividend safety score. Most recent increase around the inflationary rate, 3.5%, and an undervaluation signal when we look here, something we've noted pretty much over the last year. In fact, if you zoom out to the last 5, this one was in a severely undervalued position from mid-2022, and institutions holding 97% ownership, selling 2.7 billion, buying more than twice that in the last 12 months, buying more than twice that again in the most recent quarter. If you want to see the reversal, well, Q2 and Q3 by a fairly small distance. Now, intrinsically, it comes to $113, and you can see straight away margin of safety very large at 32%. Wall Street see this $100 into next year, we're talking 30%, so maybe one to consider if you like the REIT industry and are looking for a few companies to consider. At 35%, a buy at 74, and at 40%, we're talking $68. ARE, maybe some others, or in fact the REIT industry is not for you, do let us know. We then move on to Deckers Outdoor, down 35% in the last year, down nearly 50% year to date, half their market cap wiped out in 2025. Over the last 5 years though, they have massively outperformed the S&P. Over the last 10, even clearer. Even with the large dip where they were trading around $217, they still outperformed. 52-week low at the $94 mark. Now we get a double buy from Seeking Alpha as well as Wall Street. Although fairly weak, 3.5 is really what flips it into the buy. Forward valuation around 16.5, and we can see pretty much trading in line with the sector, but actually against their own 5-year average, they are trading at a discount in the 30s. And if we do look on a price to earnings growth, whilst historically on a trailing 12 month, it actually looks very good. When we look moving forward, sitting just below 4, sector a lot lower at 1.8. But the institutions, very high ownership, 98%, selling $3 billion in the last year, buying a lot more than 4 times at $13 billion, and we can see that continues into the most recent quarter and the previous. This is one institutions, whilst they've been decreasing the buys, continue to be net buyers. In our intrinsic price, $130, as you can see, derived from a 2% growth rate. Baked in, as of today, negative 1.4%. So if you believe even 2% is too conservative, 4 and 6 giving great upside. We've just wanted to be on the more conservative side today, where you can see a 20% margin of safety is in play. At 30%, we'll a buy at $91. Wall Street themselves see 130 into next year. We're talking 25%. Let us know your views on Deckers, whether this is a strong one to consider, and there are a few others that are up for consideration, so let us know if you want some deeper dives. We have Duolingo, which is trading towards the lower end of the 52-week range with a double buy, although a very high valuation. Some investors believe it is justified given the growth levels. We have the trade desk down 50% in the last year, year to date down 56%. Another one similar to Deckers, where half their market caps have just been wiped out, trading near 52-week lows. Another double buy from Seeking Alpha and Wall Street, as well as Fair Isaac Corporation, pretty much at its 52-week low, down 22% in the last year, down 32% year to date. We get one buy rating from Wall Street, respectable at 4.15. We have Lululemon down 25% over the last year, down again another 50% thereabouts year to date. At its 52-week low, double buy from Seeking Alpha and Wall Street, forward valuation below 14. Salesforce, one we've spoken about extensively on the channel, down 6% over the last year, down 26% year to date, trading near 52-week lows. That Wall Street buy very close to a strong one of 4.38. And we have Adobe down 38% over the last year, down 21% year to date, trading near 52-week lows. Double buy respectable again from Seeking Alpha and Wall Street. Forward valuation around the 17 point. Intuit, one that whilst is at a 52-week low right now, in the pre-market it's down 7%, it could make its way there. And ServiceNow, one that is also trading towards the lower end of the 52-week range with a strong buy from Wall Street. As always, don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.